Thank you all for coming. Again, my name is Bryan Jaffe. I work in the financial services industry. That's my day-to-day life. And in doing that, I come into interaction with hundreds of companies every year around their financials and their production processes and how they run their businesses. And through that, I've developed an acumen around elements of assessing businesses and understanding them that sometimes is ephemeral to somebody who might be starting a business or running a small business. So my goal and my commitment is to come here and share that knowledge with you in an effort that you can develop, that acumen and apply it in your life and hopefully avoid some of the mistakes that I commonly see in people starting businesses and running small businesses. I've made a fake company. You will learn two things about me today if you didn't already know them. I always start with the why do we care? And I always have a fake company, and it's always headquartered in Carlton, Washington. So I have adhered to the two regular conditions. As I go through this, I welcome your questions. This is here for you to get value out of. So to the extent that you have specific questions as they apply to your circumstance, I'm happy to, try and take the material and relate it to your individual business. And then I live here full time. I'm available. You can find me generally between Twisp and Winthrop on most days. And if I can ever be of help to you, don't hesitate to reach out. And I think we'll pass out my contact information at the end. So without further ado, cost accounting, why do we care? So cost accounting is a management discipline. It's not a discipline in the financial sense, but it is a management discipline. And it's really fundamental to two things that underpin pretty much every business, which is how do you price your product? And then does your product actually have a market fit that is viable? So product pricing and effective product pricing happens when you understand all the costs associated with building and delivering a product or a service. That includes direct and indirect costs, and I'll go through some definitions. Those are materials, labor, overhead, and depreciation. Once you understand what your product costs or service costs to deliver and what margin you ideally would like to make in order to cover your own compensation, you can then ask yourself, okay, do I think somebody will pay this much for this or buy this at this price? And it's only when you actually understand the true cost of your product can you effectively price it. And once you really understand your pricing that delivers a certain margin, can you ask yourself, will people buy it? So the goal today is to educate you on how to build up your cost accounting bill of goods and then do that market fit assessment for yourself. So cost accounting is for operators. It's not for accountants. So understanding it, liking it, doesn't require you to get a CPA or admit you actually like accounting. Oftentimes, the biggest impediment to people educating themselves about cost accounting is they say, oh, I'm not a CPA, right? Or accounting is boring. I don't want to know that, right? But while it is accounting in the vernacular, it's truly much more of an operational discipline. And most notably, it can help you avoid, some very big problems. So when you don't account for all your costs that must be covered by a sale of a good or service, bad things can happen. You can lose money on each marginal sale because you think something costs you X, but it really costs you Y. And therefore, your price doesn't clear that Y. Secondly, it's much harder to change prices once a product or service has been advertised, right? You know, if you're selling something for $100 and then you realize, oh my gosh, I'm not making any money, raising it to 125 or 150 has a negative implication in the market. And especially if you're selling, you know, through retail channels, less so online. And so you can avoid the prospect of having to change your price multiple times if you start with a true understanding of your cost. And lastly, you can drive yourself crazy selling products and then wondering why that's not translating into profits. And usually it's because you haven't pegged your costs right. So cost accounting can actually change your life. Whether you want to admit that after you've learned it or not, that doesn't matter. But it is very much the case that that is true. So I wanted to give you a couple of stories, you know, for context, and Jonathan's here so I could talk about him, but I'll talk about him second. So I'm married. Why am I telling you this? Because I'm married to an entrepreneur. And when my wife was starting her business, I had to ask myself that very, very delicate question about, do I actually weigh in? Do I give advice? Do I give unsolicited advice? I like being married. I love my wife. And I decided that if asked, I would answer, but I was not going to meddle. I made one exception. I said to my wife, if you're going to do this, you should take a cost accounting course. And I explained what cost accounting was. And she ended up doing that. And she says to me still to this day, that was the greatest piece of advice I've ever given her. Now, in fairness, I've only given her advice 4 times. So it's a very, very low, you know, statistical unit. But to this day, she will say, that's the nicest thing you've ever done for me, you know, in business. My second story is in the room. So I met Jonathan, 6 years ago? And I loved Equipped product. And I wanted to understand, you know, what their goals were. And at the time, you know, Jonathan's ambition was to replace the disposable shopping bag. And I bought his product. I own way too many of them. And I wandered in there and I started talking to him. And, you know, when he told me about his operation and I looked at the bag and I looked at the price he was charging, I said to myself, I don't think he knows how much this actually costs him. And therefore, I think it's unlikely that he knows whether he's making money or not. And so that dialogue resulted in a series of conversations where Jonathan, in fact, realized that he did not have the understanding of what his underlying product costs. And the net result was that he was losing money on individual units. And when you're selling a bunch of individual units at a loss, that loss adds up quickly. And Jonathan couldn't understand why sales were materializing at, you know, a meaningful level, but profits were not following. We've been on a journey now for about 4 years to get to the point where today Equipped has a very clear understanding of what it costs to make a product. That's materials, that's labor, that's inventory, such that everything Jonathan tries to sell, he's making a conscious decision about how much money to make or to, in fact, accept a loss. Now, ultimately, as an owner of a business, he can make that decision, but at least he's making it from a much more informed place. And so while revenue has scaled materially since those first conversations, we're now, you know, he's now owns a business that makes money because he understands how to price his product. And ultimately, he's eschewed products that don't make him margin and replace them with products that make him a healthy margin. And he continues on that journey to find and create products that have a higher margin. And the net result is he makes money, he employs more people, we create jobs, and we have, you know, a great example of a thriving manufacturing business here in Twisp at TwispWorks to point to as what is possible in this valley. And correct me if I'm wrong, if we had not gone on that journey, you would not be in business today.
Yeah, I can dig a hole so fast. It's amazing. Yeah. Hey. I love it. But yeah, to piggyback on Bryan a little bit, we had margin in our product. We had no idea how much we really needed. Like, oh, do we need to make 10%, 20%? You're like, by the time we get done these exercises, you're like, oh baby, like 20% means like nothing. It's like all these numbers started to really, and it took us years to get a handle on, like, I felt, to be honest, I'm an artist and I felt greedy. Like you feel greedy, like you want to deliver a service or a product to the community at a really fair price, like whatever that is, you're an accountant, like, I want everyone to buy a bag for $25. And you're like, no one can buy a bag for $25 because I can't make them for $25. So it was cool, Tim will back me up, he's my production manager, he really has a handle on the data. The expectation we have for our products now and the margin that we require, like, makes everyone so much happier, and the products are better. That was the other part that I realized, like, I was only shortchanging ourselves and our customers by trying to deliver a product that's such a value. Now I'm like, we cover all our overhead, like everything's accommodated for, and we can deliver something better, more reliable.
Well, and most importantly, we can walk away from sales where you're not making a commensurate margin. You can say no.
Yes.
And when you can say no, that's one of the most powerful things in business, because at the end of the day, your worth is what people are willing to pay you for that, right? And I'm a big believer that too many people underprice their products for the value that they're actually delivering. So in order to learn more about cost accounting, we have to cover some definitions. And so I put the key definitions up here. You're not going to actually have to memorize them or write them down. I'll come back to them along the way, but I'm just going to cover them real quickly. So marginal costing. So a marginal cost is the cost that you incur when you increase, your production by 1 unit. So if I make 10 and then I make 11, the increase in costs from 10 to 11 is referred to as a marginal cost. Second is a direct cost. These are costs that you can tie to a product's production, and that typically includes direct materials, labor, and distribution costs. So inventory, raw materials, and employee wages for factory workers are all examples of direct costs. Indirect costs are costs that you incur running a business, but you can't actually attribute them per se to a production unit. So utilities, right? You have a business, you incur utilities. You don't factor the monthly cost of your utilities, into your product naturally. So that's what we refer to as an indirect cost. It doesn't vary with how many units you actually produce or sell. Fixed costs or indirect costs, did I get that? No. Yeah, indirect. Yeah, so fixed costs. Fixed costs are costs that keep a company running and don't fluctuate with sales and production volumes. Rent is a common example of a fixed cost. Rent is also an indirect cost, so some of these things are overlapping. Variable costs, costs that increase or decrease with production volumes tend to be classified as variable costs. So marginal cost is a form of variable cost. So material inputs, are commonly, the most common example of a variable cost, because if you don't need to make it, you don't need to buy the underlying inputs, and therefore you don't incur the cost. And if you walk away with an understanding of any two definitions, it should be these, because this is where the mistakes are made, and this is the mistake that Jonathan was making, which is there's what's called gross product margin, and then there's gross margin. So gross product margin is the product price minus the directly attributable costs to that product. And oftentimes, if you use that to price your product, you fail to appreciate actually what it takes to break even. So gross margin is gross product margin minus all direct product costs. And ultimately, it is that gross margin that you need to be thinking about as opposed to the gross product margin. And way too many people price their products off of gross product margin and not gross margin. And therefore, they're not capturing all their costs. They're only capturing their material costs. So the best way to illustrate this is a fake company, right? And so true to my roots, I created the Carlton Caramel Company. We are a Methow made and Methow owned manufacturer of salted caramels. And like the name says, we do all of our production out of our wonderful facility in Carlton, Washington. So the Carlton Caramel Company makes one product, sea salt caramels. And we make them in batches. And each of those batches makes 20 caramels. And in order to make a batch of 20 caramels, I need 4 ounces of sugar, 1 ounce of water, I need 2 ounces of light corn syrup. You get the picture, right? And the place to start is by understanding in your recipe what the costs are, to make it, right? So I went out and I went over to Hank's today and I priced all these out. So sugar is $6.49 for a 10-pound bag. Water, I'm generously referring to as free. We get our water from the Methow River. It's in abundance. And you can see I've priced out all of these products on the units in which they are commonly sold. So the first step as you think about your product and getting to an understanding of the true price is to take your recipe, whether that is actually a recipe for a good or your recipe for a service or your recipe for a tangible product, and figure out all of the inputs and the cost of those inputs. So now the journey starts, and step one here is to calculate your costs on a per unit basis, right? So I took my 10 pounds of sugar and I times it, 10 pounds, 16 ounces per pound, that's 160 ounces. It was $6.49. I took that $6.49 and I divided it by 160, and that gave me my cost per ounce, right? Because remember, my recipe calls for 4 ounces, of sugar. And so the first thing I had to do was then figure out what is the cost per ounce. And then I went through all of the other items in a similar type fashion. Heavy cream was the one where, I had to actually do some looking up. So convert it to pints and then to cups. So that was a 2-stage. But then I had my units, right? I knew on a unit basis the cost of each of the items that went into my caramel recipe. Any questions? Pretty straightforward. So from there, I then calculated my product ingredient costs for the individual recipe, right? So my sugar, I compared to ounces. I got my cost per ounce. My recipe calls for 4 ounces. That means that each time I make a batch of caramels, I am putting in 16 cents worth of flour. I'm then putting in 56 cents of corn syrup and 28 cents of unsalted butter and 53 cents worth of vanilla extract and 60 cents worth of heavy cream. Okay, so I've got my recipe. I've got my cost per unit. I've then multiplied that by the number of units in my recipe, and I add it up, and that gives me $2.13. $2.13 is just this plus this plus this plus this plus this. And then since I'm making batches of 20 caramels, I divided it by 20. And that told me that it cost me, right, for my ingredients, 11 cents. Each of my caramels has 11 cents worth of ingredients in them. Now I have to think about the labor component. So I made a batch of caramels, and I timed myself. And it took me 40 minutes to make 20 caramels. I'm not that efficient, apparently, but I'm going to get better. And really, for the ease of math, I assigned myself a labor rate of $15 per hour. That's probably not a very generous labor rate for an artisanal caramel curator, but to make the math work, it's what I ascribed. So I took that $15 and I divided it into 3 to get the cost per 20 minutes. And then since it took me 40 minutes, I multiplied it by 2 and I divided it by my 20 caramels, and I said, okay, I have 11 cents worth of ingredient costs, and now I have 5 cents per caramel of labor expense. So I'm up to 16 cents, okay? Then I had to think about, oh, I'm not selling these caramels one at a time, I'm putting them in a package, right? So I selected cellophane bags because my caramels are very, very visually pleasing. I want people to be able to see them. I think if they can see them, they're more likely to buy them. And cellophane bags, I bought for $10, I bought 50 bags, which is 20 cents. And at first I thought, wow, those are cheap bags, but then I have 11 cents worth of product costs, I have 5 cents worth of labor, and now I've suddenly injected 20 cents per bag into the equation. I want to tie them with ribbon. I found 500 feet of ribbon for $15. That's 3 cents per foot. So I add up my packaging, 23, so 23 per bag of caramels divided by 20. That's only 1 cent on a per caramel basis. So now I'm up to about 17 cents, per caramel. And then unfortunately, the steps continue. So I add it all up. I got my 11 cents. I had my 50 cents. I had my 1 cent. That got me 62 cents per caramel. So suddenly all these pieces that I thought were small begin adding up. And then in combination, I've got 10 caramels per bag, so I'm at $6.20 for each bag of caramels. So now I then have to think about, I can go about pricing them. And once I go about pricing, I can assess, sort of the viability of the market, right? So my desired wholesale margin is 40%. And I believe the anticipated retail market, who I sell them to, who's going to sell them at retail, is going to mark them up a further 30%. So I took my 620 and I divided it by 0.6, 1 minus 0.4. That gave me my 10.33 wholesale price. I then marked it up by the retailer margin, and I got $14.75. And so I asked myself, is there a market for $15 artisanal caramels in the Methow Valley? And this should be your first point where you're saying, I'm not sure this is going to work out, because $15 for caramels feels steep to me.
I feel like that seems steep, but like everywhere I go, that's how much they cost. That's right. Like, I bought some to sew in my business this winter.
Yeah.
So they am chocolatier, and they were super expensive. It's like, all right.
Now here is the key.
So now we know who buys caramels.
Well, exactly. Beginning you Franz caramels for Christmas. So now I had to assess the viability, which was, okay, really, how many units do I have to sell to break even? So the Carlton Caramel Company rents a kitchen at $500 a month. That's $6,000 per year. I'm going to have to spend some money on making people aware of this fabulous product and its authentic origination in the valley. I'm going to spend $100 a month times 12 months. That means I have $1,200 per year in marketing expense. And then I figured that I've got about $500 of other costs. That's utilities, that's shrinkage. Maybe I'm going to throw away a batch every now and then because I didn't temper it right, or it got too hot, or it didn't set up. And every Tuesday we have Taco Tuesday at Carlton Caramel Company, and I've got to pay for that. All that adds up to $500 a month, which makes $6,000 a year. So then I said, okay, if I am going to burn 66 units per month, and that's when I decided that the Carlton Caramel Company would exist on paper and not in reality. So what might have been sweet became sour. But a simple analysis helped me avoid potentially a very big problem. The point I'm trying to make through this is not complex. This is a multi-step, multi-part problem, but it can be broken down very easily into smaller problems where you can apply logic and math and do basic things on a calculator to help you get to a managerial decision.
How do you factor in one-time costs, like equipment or something like that?
Yeah. So generally speaking, the next layer would be even more sophisticated to say, okay, what are my one-time costs? And then what's the reasonable payback period for those one-time costs? So generally speaking, you try and clear those one-time costs in 12 months. So you'd factor them into your production and your sales unit to clear in 12 months. And then if you couldn't clear them in 12 months, you'd probably ask yourself the same viability question.
How do you do this kind of calculation for a non-standard product, like a piece of fine art?
Yeah. So a piece of fine art has, the hardest thing is the labor, right? So you should ask yourself, because you can understand the material costs, right? If I'm painting on canvas, what does a canvas cost, right? If I need, oil paints, you can basically say, okay, how much oil paint do I use possibly? You could estimate it, but ultimately your time is going to be the biggest component, right? Of the value proposition, of artwork, right? And there's a couple ways to think about it. Way number one is perfect substitution, which is to say, if somebody came to me and offered me a job at X per hour or X annually, would I do the art or would I do this other thing, right?
Basically opportunity.
Exactly, opportunity cost. And opportunity cost generally provides you a framework to think about, what you would have to make at a basic level, right? You can then obviously look at, and I understand this is an imprecise thing. What does art sell for of similar media, right? in, this market. But generally speaking, the way I would think about it is to say, what's the opportunity cost? Do I think I can clear the opportunity cost sufficiently with enough confidence? Because it is very, very hard to say what is an hour of an artist's time worth. But I think the same logic applies, which is you can take the aspects of your art that are directly traceable. You can track your time, how many hours it takes you. You could think about what your worth is, on an annual basis elsewhere, and come up with a proxy calculation. And you could say, okay, can I sell this for more than $1,000? And then you can assess, what the viability of that is. You can talk to a gallery, a Confluence, and say, hey, do you think someone would pay $1,000? They'll probably give you a reasonable answer as it relates to that. But you are hitting on, an aspect of pricing that is not efficient, right? Beauty is in the eye of the beholder, in art, right? And as you build,
it's really hard in the materials. You may use a gram of something one time.
Yep.
The next piece you do,
Yeah.
you may use a half pound.
yeah. So and I'll get to this a little later. The other way to think about it is what's called activity-based costing, which is, okay, how much paint did I use in a year? How many paintings did I do in the year? What can I reasonably then say, okay, X divided by Y gives me my material cost. But again, you're going to see wide variability, right? Because you might have a big canvas, one painting. You might have a small canvas, one painting. You might have multimedia. So I'm trying to answer your question the best I can. But you're absolutely correct. It is an imprecise and inefficient market where, again, ultimately though, thinking about the cost, what you have to pay, right, to enable you to do this work, and then can I get above that, right? Can I clear it, right? Would be the most logical way to build up the problem in my mind. So ultimately, I've abandoned the Carlton Caramel Company. I regret to inform you all we are out of business before we are in business. So cost accounting has some other considerations that you need to think about that will complicate your life. And the first of which is cash accounting versus accrual accounting. And this is a real problem when it comes to cost accounting because if you practice cash accounting, and most of you in small business will, you are expensing product inputs at the time that you purchase them. But you may not actually be generating the revenue associated with those for some other period of time. So one of the complications Jonathan had was, I buy vinyl in November. I incur that on my tax payments in the year in which I buy them. I then use that to make bags that I sell next year. So I have a timing mismatch between the revenue and the cost. Accrual accounting is there to solve that problem at the expense of very significant pain and suffering for the small business manager. But at the same time, as long as you're aware of that frailty and you take time out of it, you can actually reasonably compensate for that. Because again, it's much more important to focus on the unit, regardless of when the unit is sold. And if you do your pricing build-up that way, the cash versus accrual accounting mystique should largely dissipate. The other problem is you have underlying costs that fluctuate. The cost of sugar may have been $6.19 this week. It might be $6.32 next week and $7 the week after that. But I've created a pricing schematic at a point in time. And I talked about earlier the challenges of changing your price later. So the way to think about circumstances with fluctuations in underlying costs, there's a couple of ways to think about it. So the way that traditional accounting would deal with is what's called standard costing, which is you would simply calculate a unit cost. You would always apply that unit cost to your income statement. And at the end of the year, you'd look at what you spent and you'd book what's called a variance from that. Accrual accounting, that works. It doesn't work in cash accounting. So what we generally advise people to do is to think about costs over a 12-month period and use the highest individual component and the lowest individual component and understand the spread. So if the only price that moved in my Carlton Caramel Company recipe was sugar or flour, let's just use that, and everything else stayed the same, I would look at, okay, what would be my underlying cost when sugar was at its lowest price, when it was at its highest price, when it was at the average. And as long as that spread wasn't too much, I would probably go with an average. But the larger point is that is always going to be a risk, right? Because the underlying inputs to your product, those prices will change dynamically. And if your price is static and you don't have the ability to dynamically price your product, you are always going to take that margin risk associated with the underlying, costs until you seek to pass those on to customers, right? And this is something that we all experienced, during this inflationary cycle, which is we saw consistent price increases of things that we bought because the underlying costs were rising for the people who were making them. And that actually led to a lot of switching, and brands that had a lot of loyalty saw that loyalty dissipate. And so it is a real challenge, in running a business and also, thinking about, how to cost your product. There is also a discipline called activity-based costing, which is to look at individual activities, price those activities, sum those activities up. And if you practice activity-based accounting or costing, some of those variances will wash, meaning you'll have overages in some areas and you'll have underages in some areas, and then when you all add them up, it should kind of, dilute itself. If you're interested in learning more about activity-based costing, there's a whole discipline that, I would characterize as separate and distinct from traditional cost accounting, and so didn't cover it here. You've got to actually get a second, 201 course in that. So I wanted to give you some resources, places to go, things to read that might help you in you on your journey. And I'll point out one specific thing for you, which is this article on cost of goods sold for services businesses, because I kind of think of like art as a product, right? But at the end of the day, costing the underlying elements of it is a service. And it's actually a very good article for how you should think about cost of goods sold in the context of, a business where you're really selling your time, right? But 2 books, Mike Piper's book, Cost Accounting Made Simple, super cheap, very good, covers a lot of the bases. If you're ultimately, going to make a perishable product, you're a bakery, you're a caramel company, the Book of Yields, Accuracy in Food Costing and Purchasing by Francis Lin is like the Bible that people ascribe to. So my wife should teach this course. This is what she does as part of her living. She has a website called Small Food Biz, where you can purchase software-based tools to actually do some of this. So there are templates. She has one. There are others out there that you can buy. There are some that are free. So what I would say is a lot of this can be automated and simply. So to the extent that you actually want to go down this path and figure it out, you can buy tools, that you just put in your inputs and it'll spit out, the outputs based on parameters that you provide. There's also, this food cost calculator also is good for, if you have a recipe-based business. So, kind of just to sum it up, cost accounting is not something that you should be scared of. It's actually, quite easy. You can break it down into small steps, and ultimately what comes out of it can be exceedingly powerful in helping you make good business decisions. And like I said, the mistake people make more often than not is they price their product off of their material costs and not covering all of their expenses of running their business. And the net result is they're disappointed at the end of a period when their underlying revenues don't cover their underlying costs. And so it's a very good proxy before you launch a business or launch a product or launch a product extension to go through an exercise like this to make sure that the likelihood of success is going to meet your expectations. Again, cost accounting is there to help you avoid problems before you make them. It is a lot harder to rectify the situation in process like Jonathan has had to do. So hopefully that's been helpful. I'm happy to answer any questions.
Do you have a resource for benchmarking the wholesale and the retail rates? Like your math was great on your caramel example and you had a 40 and a 30% up there, but where'd they come from? Is there some place to look at? This is worth you.
Yeah, so you can, the best way to do it is to talk to others. Generally speaking, that wholesale and that retail is what I find is the benchmark rates in the food industry, consumer packaged goods. To be honest, most good online forums, if you ask the question, other people, will answer. So people are generally, happy to share that information, but the way I generally think about it is a business that cannot produce a 40% gross margin over time is going to have a hard time generating sufficient sales for long-term viability, because the cost of rent and labor and marketing, you just generally see a much higher correlation of successful businesses that do 40% gross margin or better than you do below that. Now, there are examples of businesses that succeed wildly at lower margins, but that's because all their costs are what are called above the line. Mm-hmm. So for example, if I'm making birdseed, so birdseed is a 15% gross margin business. Yeah. But there's actually very little operational cost that falls below the cost of goods sold line. So 40% is generally a good heuristic, as a baseline in any business to think about, can I cover the rest of my expenses?
And so if someone we have wholesale and retail,
Mm-hmm.
we're trying to figure out pricing. So we take you have the two-step process. That's what we should do internally as well. We figure your wholesale and then you add the retail on top.
Correct, yes. So the wholesale margin then is there for you to assess your ability to cover your costs, right? Mm-hmm. The retail margin you factor in to assess the viability, because you want to know what is the end consumer going to have to pay, sure, and assess whether that is a price that would be viewed as an attractive, value proposition. But ultimately, that's money that the retailer puts in their pocket, doesn't go into your pocket, but it should factor in because it impacts how you think about, units that you might sell in an individual retail channel, right? And then the other thing is if you are selling through wholesale and then you're selling online, right? You want, your pricing to generally be uniform regardless of those channels, right? So if you have a product that you're selling online where you haven't factored in the retailer margin, what's going to happen? Your retailer is going to be at $15 for your caramels, and online you're going to be at $10. And what's going to happen? Your retailer is going to say, "Why am I selling this? You're selling it over here at $10. I'm selling it at $15. This is just not going to work, right?" And you're going to lose distribution that way. So it's just the rule of 40s is pretty powerful in consumer packaged goods. 40-30 tends to be where I've seen most traditional retailers these days. But what I also find is people are delighted to tell you what they think, right? So you just have to have the gumption to go ask, and find somebody who's, got the answer to that, right? Other questions?
Quick question. It's kind of for you and Jonathan, and I'm not sure if this might be more of a marketing question, but when you guys found out that you were underpricing your product, and you realized that you have to, I guess, raise prices, like what was the process for that? Like how did you...
Have you ever seen an unwilling person go to the dentist? That is the best way I could describe it. Jonathan, you have to raise prices. We can't raise prices. But you're not making any money. Oh, I don't know that we can raise prices. But you have to raise prices. I don't want to raise prices. Do you want to be in business? Or do you not want to be in business? I want to be in business. Okay, you need to raise prices. Now, he answered that question actually very differently than that, which is he said, okay, I have to find a different product that I can sell at a margin that is viable. He didn't seek to make last bags, the margin profile that he was targeting for his whole business. And that's why you see gear buckets, as an example, and some of the artist series that Equipped is doing, because those generate the margin people are willing to pay to support the viability of the business. So it wasn't the case where he just took what he was selling and said, okay, the price today, yesterday was $18 and today it's $24. I think he thought about it much more artfully and said, okay, what can I make and what can I sell that will generate, this type of margin, so I don't have to throw the baby out with the bathwater. But I think there is a huge propensity among operators to be very, very cautious about raising prices. And again, I'll go back to something I said earlier. I guarantee all of you are underpricing your value in the market. And the way the world works, you don't ask, you don't get, right? Nobody, you might list a painting for $1,000. Nobody comes to you and says, "This painting is so wonderful, I would like to give you $2,000 for it." I know you're offering it for sale for $1,000, but here, take $2,000 for it. Unfortunately, that's not the way the world works, right? And there's very interesting psychology that consumers actually back into, pricing tells them something. If it is high priced, in some cases they equate it with higher quality or they equate it with better. So that's not to say that, I encourage everybody to look at the highest priced product in their category and raise it. But I think you should value yourself appropriately, and don't be afraid to reach a little bit, because it's more often than not that you'll be rewarded, because on an individual unit basis people stretch all the time. Over a long period of time, maybe less so. Other questions?
What does everyone do here? Like, what do you make? Like, what do you do?
Well, I'm here for two reasons. So I'm actually...
Not to put you on the spot, but we're going to put you on the spot.
So I can see your answer. Yeah,
I'm just curious.
Yeah, so I support a service company and I do their financials, and so we kind of do a lot of this, but they have huge margins built in, so I think we have a little more wiggle room. But my husband and I, so I live in Leavenworth, my husband and I just launched a handmade pretzel business.
Nice.
And so my questions are all around the pricing, obviously.
Yeah,
So we know
yeah.
what our market will bear, but
Yeah.
we're underpricing because we're from the Midwest and we like to be nice. But I still like some money to go back in my bank. So that was my question.
So how many of you had Dots pretzels?
Are you Dots pretzels?
No. So I'm gonna get back into Midwestern success stories. So Dots pretzels sold that business for $1 billion.
You know, I don't need to sell it for $1 billion. My goal is a little lower.
The point being, people like pretzels, and you can still have Midwestern values and build a very successful business. She made pretzels for a lot of other people too.
I will say that's one of the most wonderful things that Bryan has taught us. Like, he gave us a foundational perspective, and it's like up to us how do we apply it to our business. You know, we have our values, or we have our predisposed notions of things, but like at the end of the day, we're more successful and have more fun because of this, and it makes us more proud to sell our product versus constantly struggling to convince marketplaces or to convince people to buy our products at lower margins.
Well, we've distilled it to a very simple question, which is at 40% margin, would you be proud of selling this product?
Yeah.
Right? And I think you look at everything now through that lens.
Totally.
And there are products that you design and you say, no, someone's not going to do that. And then there's some you're like, I think they pay more than that, right? And those are the products that you latch onto, right? And seek to sell. So the great thing about how you've taken that discipline and applied it is you've actually simplified it to one question, which is, would we be proud to sell this product at the margin that we know we need to make in order for it to be profitable for us?
So, but are you essentially needing to be planning to have a 70% margin over the cost to account for retail, so 40% for wholesale, and then the extra 30% for retail? Is that, just want to make sure I understand?
Yes. Yeah, that two-stage distribution. This is why Amazon is Amazon, and this is why people like selling their products at farmers markets, because at the end of the day, if I only sold my caramels at farmers markets, I would have to sell 30% less of them to end up in the same spot, right? So maybe there is a viable market for my $10.50 caramels at farmers market throughout the Eastern Washington area.
I know what you do. But I don't know.
I own a small winery with my husband, Rizo Wines, and we just opened a tasting room last June. And I was at this. I always feel silly because I'm like, well, we've already had a business for a few years, but he has a really solid understanding and I do not, so I'm just trying to get better. And like, as an example, like again with wine, you make like 2 years in advance, so it's all the things, and he has really big spreadsheets and stuff about all of this, but as an example, like I did a couple events last fall and I think I gave people like a total steal because I was like, and then I was just like, I guess I'll do it for this much. And they were like, oh, wow, okay, wonderful. And then later.
You're like, I did an event and I sold them for $10, and I did an event I sold them for $30, and nobody said anything about the $30 price. And then you're like, how many bottles did I sell at $10? Multiply that by 20, and that's how much money I got left on the side of the road. Yeah.
Anyway, so
but I mean, the other thing about the great thing also about a tasting room is, right? Like, when you serve food, you have this opportunity to dynamically change your prices all the time, right? Because you can change your menu, right? And cost accounting is a fundamental discipline in running a food service establishment.
Well, and that's why, because I'm sort of more in charge of the tasting room, so I just want to have a better understanding.
Well, I'd like to tell you, you're doing a very good job.
Oh,
you're doing a very good job.
Thanks.
We appreciate having you over there.
What's the name of your tasting room? It's called Rizo Wines. It's on Glover.
Yeah. It's the new looking place with the see-through windows and everybody smiling. Anything else?
What do you do?
I don't have business yet, but I'm a fiber artist.
Oh, nice.
I'm thinking about starting an actual business and trying to make a little bit of a profit.
Nice.
But it's complicated, like we were talking about.
Yeah, well, it's best to think first, right? Like measure twice, cut once, so to speak. So you're doing the right thing, getting yourself
What it
educated.
takes to actually make a business out of it.
Yeah, yeah.
I like how all the artists are sitting in the back.
Yeah. I wish I had a better answer for you, right? Again, art is one of the most inefficient markets, right? Because beauty is in the eye of the beholder. And that's why auctions are very powerful for...
To a degree. I mean, there's prints and cards and things.
Yeah.
Oh, yeah, absolutely. Yeah, yeah.
I think I'm gonna be printing those right
Yeah.
We need to have like an accountability group where we all actually do our homework.
I'm a watercolorist.
Okay.
Yeah.
And yours is?
I'm sort of a weird mush person. I do watercolor and I make illustration for magazines and sell prints with those, and also do freelance magazine writing and freelance magazine reading. So I diversify.
Yeah,
Well,
you're a jack of all trades.
What's that?
My Hannah?
I'm Sarah.
Sarah.
But I'm working at a studio.
Okay.
Awesome. Well, thank you for coming. Like I said, I'm here. I love helping people. I love sharing knowledge. Obviously, to the extent that you have feedback on this session, would love to know the good, the bad, so that we can incorporate that into future sessions. And if you ever want to chat, I make myself available. If you're in the food